Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Welcome to my latest video. It's entitled 3 Ways to Improve Your Stock Market Returns. When I say your, I mean the royal your, or royal we. It's really much a note to oneself. It's like lessons learned that need to be said often and repeated loudly. Because a lot of these lessons we learn, we sort of forget about, and then we sort of veer off and veer off the path of what we've learned, of knowledge we've learned and picked up, and we start picking up bad habits. So to say them loudly and repeat them often is very good. So listen, if you like this video, by all means hit that thumbs up button if you can. If you want the next one to your inbox directly whenever I release one, so basically you get an email saying Justin has released a video, subscribe and hit that notification bell. Don't forget the bell. Oh, that bell. It's so important. Many of you may, recognize this man. He's quite well known in the investing community. He's probably the greatest ever investor. Warren Buffett, of course. And if you'd invested $10,000 in Berkshire Hathaway, which is his company, in 1985, that's a picture in there, 1985, you'd now have 2.4 million. The same principal, same amount in the S&P 500 would be worth now $227,000. Still good, but not as good as Warren. And compound gains, whenever you compound gains, it can be a massive effect over a long period. So look, this is the difference basically. It's about 7%. That's all it is, a year difference. So since 1985, Berkshire Hathaway has posted average annual returns of 17.1%, including dividends. The broader stock market has returned 10.5%. Berkshire Hathaway don't pay dividends, so that's capital increase alone. All right, so you can see that 7% has made a massive difference from 2.4 million to 27,000. So what gain are you targeting? I've been thinking about this a lot. And it was hard to say, this year I'm going to make 30% increase. What you can do is look at individual companies, and hopefully that will add up to a decent gain, all right? So if you look at the gains, compound gains over years, if you manage to get £10, that's 10% a year, all right? You start off with 10 grand. Okay, after 10 years, you're double bagged there. Double bagged in a third, so 230%. So 23 grand off 10 grand. If you just compounding 10%, all right? Over 20 years, that'd be 61, 6 bagged over 20 years. Not bad. 15%, of course, 35, 3.5 bags, 14 bags there over 20 years. 20%, this is Warren Buffett territory, and this is very hard to do, 20, because if you take into account the crashes we've recently had, it's everything from the big rises you've had, the good years and the bad years rolled into one. Compound this is. So he's done pretty much, he turned like 10 grand, 50 grand over 10 years. And also it's about size. When you're quite small, it's easy to double your portfolio because you're putting a lot of money in one stock pretty much, and it can double. So when I started sort of seriously investing, the last great financial crash, and I sort of all went into Lloyd's, I started off with not very much, but started doing very well. I was doing bagging, doing very well. I was doing between 30 and 50%. And if you work that out, I started off with a very small amount. After 12 years, I'm thinking about 40 odd percent. As your portfolio gets bigger, the value gets harder, of course. And so now I'm looking to target anywhere between 20 and 30%. And that's optimistic. But yeah, so I've done sort of, if you look 12, 13 years, I've done 50 times my portfolio value initially. Now, like I said, a lot of that was because I overexposed a bit and went a bit crazy. Now, I'm never going to earn the return I did back then because my portfolio is now bigger, but I'm still looking to gain, a decent chunk. So here we are. Whatever you are targeting, whatever returns you're targeting, there's a way to improve your returns, okay? Now, it's basically discipline. And I like what Warren Buffett says here. In the securities business, you literally every day have thousands of major American corporations. Securities means investments basically, or assets, equities. Thousands of American corporations offered to you at a price, and at a price that changes daily. So you're going to offer there every day. They change on a daily basis, and you don't have to make any decisions whatsoever. Nothing is forced upon you. there is no so-called strikes in this business. So it's not. He did compare it to baseball, because baseball you've got to swing for the ball. You've got to go. You've got to make an attempt. In the stock market, that'd be a nightmare. You get 3 attempts, buy a stock. You don't. You have much time as you want. And that's why you've also seen Warren not buying a lot unless there's big corrections in the market. And then he starts buying because he realizes over the long term, there are opportunities. I'm not just saying wait around for those corrections, but definitely wait for the price to come to you. I'm going to show you some examples of where I've done right and gone wrong here. So 3 ways to improve stock market returns, okay? Here they are. Get a good entry price. This seems quite obvious, but it's quite hard to do. And I'll show you recently I went wrong. And I'm going to have to sit there now or just get out. Number 2, limit the downside. Of course, if you're not making a loss, even if you break even, if you're not making a loss, then there's only 2 sides to the equation, isn't it? Either you make a loss, you break even, or make a profit. If you cut one of those out of the equation, the making a loss side, then you've improved the chances greatly of you earning money. So if you're going to make a loss, try and make it small. And I'll go into details of these. And third, of course, maximize the upside. So let's go into the first bit. This is my portfolio, okay? Now, these are the different kind of shares I own. Pre-revenue, high risk here. And you can see a video up here of the filters there. The previous filters I put these through to get to this stage. So I don't just pick these companies. There's stages these companies have to get through to get in the portfolio. If you don't meet those criteria, and like I said, Salt Lake Potash of the week hit 9 of the filters that's in the first filter, and he got there. Now that's why I bought it. And right now it's up 63%. 90% is my target. I'm not saying I'm going to stop there, because that would be limiting my upside, but that's what I'm aiming for. Polarian, of course, down 6, up 15. E-Energy, MPAC up 16. These are now 60%, because they're further along the development curve. They're higher valued. They move less fast. They're a bit less risky. There's growing stocks. Again, they have a separate filter to this one. So Manlet is the one I've made a mistake on, really. Didn't get a good entry price. That's number 1 I've messed up on. And Tristel at 16. So they're not doing too badly. I'm again, I'm going to have to think about this. Tristel's a good company, but I don't know if I'm going to get that extra 40% in a year. And there's a way of doing this. I'll show you in a bit. Greg's, 3%. HSBC, I just bought that recently. I'll tell you why. And, of course, Barrett Development of 3. These are my exposure to these companies at the moment. I've still got a lot of cash here, because I do believe we'll have a retest of those lows. Or there'll be opportunities. Like I said, there's always, like Warren says, there's always opportunities there. And I think there will see some. A Vanguard fund, I'm looking for around about 10% a year. Okay, so first one, get a good entry price. This is SO4, Salt Lake Potash. This is where I get a good entry price, and it's paid off straight away. It came from an oversold position. They've raised some money here, and it's going to take them through to cash generation. So, of course, cash generation is going to happen in 2021 right here. It's going to start generating cash and making money. Already, I've got 63% locked in here, pretty much. Well, I haven't put a stop loss in yet, but it's there. This is my target up here at 40 pence. I've got 32 pence already. That's the price at the moment. I bought at this level on here, 19.9, 20%, 20 pence. But like I said, this is the risk-reward ratio, 3 to 1 here. But in fact, I've got that wrong, have I? No. So anyway, I'll show you later. So this is a good buy. Good example of, look, come from an oversold position, hit the bottom there, up and down, retested that level, and then broke through up into strength. And the RSI broke through the 50-year into strength. So we retest. That is a good entry position. All-time highs up here. This is where I got it wrong. Recently, Manlet partners are in litigation for insolvency litigation, which is going to be a big area, of course, in the downturn at the moment. So I just liked them. They wouldn't come back. I bought them here originally. Sold it. No, I bought them here, I think. I sold them in the dash for cash, the crash. The dash for cash crash. Easy for me to say. And I had fear of missing out, because I realised they're a strong industry. If we are in a downturn, this is a contrarian play. If the economy goes downwards, this will go up, because they're, like I said, insolvency litigation. And so to get that 60% on this is the growth stock, you have to get to 918. We're now at 574. I don't think I'm going to do it. Not within a year. That's a lot to ask. It may do. I'll wait and see, because the results are going to be strong, but I'll see where it's going to go. But I don't think I'll get my 60%. And like I say, I'd like to reiterate here, you can buy a bad company at a good price and make money. It's mostly about the price, and you can buy a good company like man at a bad price and lose money, and I could do that. I bought a good company at a bad price. The ultimate goal is to buy a good company at a good price. If you do that, then you'd have a long-term sustainable rise in the share price, and you're sitting on a nice profit for a long time. So number 2 is limit the downside. This is quite obvious. There's 2 ways of doing this, really. You can set a stop loss, which will sell automatically. You place the stop loss in there, sell automatically if the price drops below a certain level. And so, for example, here, I just bought HSBC. I'd run about 370. No, I bought about 380, I think. But I'm looking for 30% on this, 10% down. So if you look at about 3-to-1 ratio, you're always trying to get that. And it's doable. Look, that's nowhere near its all-time highs. I mean, it was up near 6-7 quid, I think. So it can be done. That 30% target is running at 470, 480. So it's, a nice bounce here, up through the gap. It can do it. But it could keep going down. And I bought it at the wrong time, really. Here again, I should have waited until at least the strength was going back up, oversold and going back this way. At least then it would have gone up. And I could have put a decent, line here. If it goes below this line, this 4 quid line, it's probably not a good sign. But it's done that anyway. We'll have to see. So that's one way of limiting the downside. Just put a 10% drop in it. So if it drops 10%, sell. With a big stock, that is. You probably need a bigger margin of error, percentage-wise, stop loss, for volatility, for higher volatility stocks like small caps. So that's one way of doing it. Just literally saying, right, I'll cap my losses at, I'll take 90% away. I've lost 10%. That's one way of doing it. Another way is limit exposure to a company and scale in. And this is why I do this. This is my preferred option, really, because like I say, I have filters a company has to go through, and when they meet that criteria, I've already sort of given them the quality check. I'm just jumping in, So your total exposure to one company essentially is 9%. So if it goes completely wrong, the maximum you've lost is 9% of your entire portfolio. If the company goes collapse and bust, it shouldn't do. If you've put your quality, if you've done the research and it goes through your filters, shouldn't do that anyway. But if it does, 9%. If you're fully exposed to that stock, 9% is the maximum you lose. It's still a big chunk out of your portfolio. So what I do is this. Again, another sort of fail-safe, really, is I scale in. And so my initial capital allocation, for example, for HSBC, I don't know what lead price this is Manalet, but let's say you've got a £100,000 portfolio. So this is not my portfolio value. I'm just using this for round figures, for percentage terms. 9% or 9 grand is total exposure. Your first tranche is 3% or 3 grand. So if your first tranche is 3% of your overall portfolio, downside will be limited. You only lose 3%. Now, not many companies, if you've done your research, will go through. So let's say you get it really wrong and you buy at the wrong price and it drops 50%. You've only then lost 1.5% of your portfolio value. So that's another way to limit your downside, okay? And the third one is to get better returns, is maximize the upside. Okay, now this is easy to say, but I'll show you what this means. The maximum risk is 100% on any stock, pretty much, like I said, if you put everything into it. The maximum reward can be many, many times 100%. So really, the odds are stacked in your favour. If you play it wisely, like I said here, if you play this wisely, it's not 100% if you limit exposure and scale in. If you, first of all, only limit to 9% of any one stock and scale in, so you go in tranche of 3%, then you're only going to lose maximum 3%. So literally, the maximum here is not 100% of your portfolio value, I'm talking about. But, of course, if you pick a surefire winner, it could go up, it could be multi-bags. So, let's look at this. This is a busy chart, so I'll try to explain this. Sorry. So this is the target price for me. It's 37 for a 90% return. This is for Salt Lake Potash, okay? I bought here at 19.9. Risk reward, pretty much. The risk reward of, is it 9 to 1? Look. So 90 to 1. So 10% down, 9% up. Okay? If it'd gone below this level, which is a good level, you see, it bounced up. It cut this way. If it'd gone below that level there of 17.8, probably time to get out. It may have gone lower. But, like I said, I bought here on strength. It retested. It came up here, retested, and then went back up. The RSI is picking up strength. It's not the time to buy right now. It's strong. It'll probably come back and go here. But look at this here. The all-time high is at 48 pence. The all-time high is 30% higher than the target the company's growing at. So what I won't do, I won't just, as soon as it hits that, take my money and run. Because I believe this company could be a big company. There's lots of projects going on. Like I said, check out my previous video on Salt Lake Potash. There's a lot of potential here. Insert a stop loss to lock in the profit all the way up. Don't limit the upside though. So you can limit the downside on the way up. So if it's where I am now here, I could say, listen, I'm not going to be greedy, but I know it's quite volatile, so I'm going to maybe put a stop loss at say 28, or even 25. So at least I got some profit locked in, but I don't want it to trip me out, because we are going to have a cooling off here, and it's going to come around. So you've got to expect it to pull back. But if the story doesn't change, there could be more upside than the actual target. So don't put a limit on that upside. Like the old saying is, same as saying basically, let your winners run, cut your losers quickly, and don't let your losers run, pretty much. So it's literally, don't limit the downside. Oh, sorry, don't limit the upside. Maximize the upside. Limit the downside. If you cut those losses, or you reduce exposure to those losses, like by scaling in, and you let the upside run, that will greatly help your portfolio. So set a stop loss to lock in the profit. I did this with Auto Trader recently. I said I held this until last week. It's a big cap stock, so it's the 30% I was looking for. I got 31.8%. I did this by putting a stop loss in, and so it was here. I bought it at strong through the RSI again. It'd gone oversold here. It built up. I bought around at 423. It's gone up to 5. Yeah, I think it went up to about 58 from that. I put a stop loss in around at 550. But then and also the all-time high here is £6, and they're at 558, and yet car sales aren't open in the UK. So this is nuts. This rally with just momentum is crazy. It's got to come back. It's a good company, But like I said, the all-time high is only 10% higher than Target, and the company's not growing at the moment. It's shut. Oh, they're pretty much. Car sales are shut. It's an online website. It's the market leader, of course, in online car sales sites. So essentially, I was happy taking this profit here, but I put a stop loss in the year, tripped out, and I sold. Okay, and I'm going with HSBC. I replaced that because I think there's more upside there. Again, with HSBC, I've only gone 3%, and so I can put, like, if I want, a 20% stop loss on that. And do your math on that. Off 3%, what's 20% of 3%? Well, 50% is 1.5%, so less than that, 1%. So I'm rubbish at maths. That's why I need a calculator. So hope that made sense. That was, as a reiteration there. First of all, how to get better returns, get a good entry price. That's essential. I've messed up on Manlet. I'm probably going to have to sell that. Or maybe it'll come back. Will I scale in? I don't know. Like I say, I'll wait for the results to come out to see what happens. Limit the downside, very important as well. You can have some multi-baggers in your portfolio, but if you have a load of losses as well, it'll take the shine off that gain. So limit that downside, and then maximize the upside. Don't sell it short. Lock in the profit maybe, but don't put the stop loss too tight, because I've seen people stop losses trip out, sell the stock. The stock's going on to do multi-bags. So be careful. Look at the chart. If it looks like it's going to come back, Salt Lake Potash, RSI is 70. RSI can go to 100, theoretically. But, so it can go a lot higher. But I'm expecting to cool off sooner or later before another rise. All right? Thank you for watching. I hope it made some sense to you. It did make a bit of sense to me, hopefully, because it's always good to write things down, And I do a video, and I say it's to remind myself more than anything. But if it helps you, thank you very much. If you've got any questions, if anything didn't make any sense, by all means, comment below in the box, and I'll try and get back to you if I can. And like I said, if you want this next video to your inbox, don't forget, hit that subscribe button and the notification bell. If you just hit subscribe and not the bell, you don't get notified. That's what that makes sense. You just see it when you read my videos. When you come online onto YouTube, you'll see them in this sort of amongst the rest of them. But if you want to be notified via inbox, then hit that bell as well. Right now, you can subscribe by hitting my face right there and clicking the notification bell. And if you want to see some other videos, right there. Okay. Thanks very much. Speak soon.